Good morning. How you doing? This is Coach Ernie, and this is Zero DTE War Room. We do this every morning on Monday, Tuesday, and Wednesday. Every week we do a series of various topics surrounding Zero DTE trading and the way we actually do Zero DTE trading. So that's a key. And our goal really is to help you become consistently profitable, independent, and trade at a pro level. It's super important. That's the mantra. Consistently profitable, independent, and trade at a pro level. Yesterday, we talked a great deal about volatility, the VIX, and how it affects our trading, particularly what the VIX does to premium decay and the rate of premium decay, and how that affects our stance to the market, how wide we make our flies, etc. And it is really the primary driver. I showed you how I split up the market into various regimes, basically low, medium, and high, but I call them Zombieland, Goldilocks, and Chaos. I think it's it plays with the mind better. And then I was talking about this concept and showing you why trading small and trading asymmetrically is a huge advantage. So today what I'm going to do is I'm going to show you an actual account that I traded as a demonstration, real money, in my Zero DTE trade room for, I think it was about a year and a half. And I actually have several accounts, and I've been assembling them all so I can have one consolidated view. But each account was attacking a different problem, a different strategy. But they're all around Zero DTE. So we might have a glimpse of that today as well. But really what I wanted to emphasize today was this concept of the roundabout and what it is that we're actually doing. See, most people get into trading thinking that every day is an opportunity to kill it, right? And that's simply not true. The market's going to give you what it's going to give you. You can't, what's the saying? You can't extract blood from a stone. If it's not there, it's not there. The best you can do is put on a risk-adjusted trade that will put you in the best position to be able to get an opportunistic gain. That's it. Now, you can maximize that and you can lean into it, but it's still, that's the situation. It really depends on what you're going after, obviously, too, and how much you're willing to risk. The more you risk, the greater the fall. So our basic stance is to risk as little as possible to keep the drawdowns very small. So that's another thing that we'll talk about. We'll talk about how you figure out that proper position size. Why don't we get started? Oh, first of all, we're going to do what we always do and do our routine. It is pre-market, and we need to figure out exactly what we're going to do today. There's always an opportunity, a potential that we could take a trade while we're in the room, but typically they happen somewhere between 9:45 and 12 o'clock, so there's no guarantee that we're going to get it there, but we'll still do the setup and why we're here. Let me just make sure that we have everything that we need. Just getting TradingView up and running, and of course our fly in the wall application. And if you've been following along, then you know that what our routine is. All right, I'm just getting it all set up for you. Of course, it wasn't set up. There we go. All right. So the three primary things that we're trying to achieve pre-market, part of our routine, aside from the personal readiness. Do I look ready? I've already taken a shower. I've exercised. I've got my Death Wish coffee and my Death Wish coffee hat, so I'm good to go. My desk is relatively clear, and my mind's into the game. So the next thing that we need to do is figure out what is our stance going to be against the market. We want to know where volatility is, and we want to know where market structure is. Because when we're taking a trade, first of all, we're trading with the trend. We're looking for where and when we're going to trade, how big we're going to trade. VIX will tell us a lot of that. VIX will tell us specifically how big we should trade. Now, what are we trading? We're trading out of the money butterflies. Why are we trading out of the money butterflies? Because we're trying to put on an options position that has both directionality and optionality. And we can control our risk, right? We can define the risk very well versus our profit, so we can get the kind of risk to reward that we're looking for. And that's going to lead in later when I start talking about position size and how we figure out how many of those positions do we put on. First thing to do is figure out where is the volatility. That's going to essentially tell us how wide we need to trade. So let's look. If you're, by the way, if you have comments or you'd like to say something, go to the comments section, put it there. I'm monitoring it. I'd be happy to answer questions along the way. And if you like this content, please give it a thumbs up. So let's go to, oh, look at that. It went right to it. Cool. So this is my VIX playbook, as I said, where I have it split up into regimes that I call Zombieland, Goldilocks, and Chaos. Our favorite part of it is Goldilocks. It's just right, but it's a big enough zone that I give it two. I split it up into two, Goldilocks 1 and 2. All right, and these are all of our strategies. There's two edge case strategies for super low volatility, very high volatility, and then our more generic strategy, what I call the classic out of the money butterfly. And again, our goal is to figure out how big of a trade that we're going to be putting on today. Right now, the VIX is at 24.5 approximately. And so that puts us right smack dab in the middle, exactly in the middle of our volatility regime guide. So we're right about between Goldilocks 1 and 2. And so you can see on Goldilocks 1, we're looking at 30 to 40 wide, and Goldilocks 2, 40 to 50 wide. So I would say that we're probably around 40. That's a good guess. We can fine tune that too if we want by going up and looking at an indicator, a self-made indicator, looking at a 50 wide fly and then looking at its debit at the money fly. And that will tell us, should we be leaning more towards 35 or 45? But we'll get into that later. I'll talk about that in another episode, and that will bring up another edge case trade that we call the big ass fly, which is essentially a 50 wide at the money fly that we take pre-market, which means that you would have to have a futures account or an account that supports trading the SPX pre-market. All right. Let's call it 40 wide, and we'll go over to our app, and we're going to, what I would normally do then is put on a 40 wide fly. Now we got to determine, are we above the market or below the market? Let's see here. I'm not logged in, so I'm doing this behind the scenes. All right. Sorry for the delay. Get back to trading view here. There we go. All right. The next step in our pre-market analysis is to figure out where we're going to trade. And that's where we analyze market structure. By the way, tomorrow, that's going to be our main focus, is on market structure and volume profile. And I'll show you how I do the analysis of volume profile and how we use it. But that's what we're going to do next. So we go to the E-mini S&P futures for that. And I'm going to go to a daily chart so you can see how I have it marked up. All right. So this is the volume profile over the last couple of years. And you might wonder, why am I using a couple of years of volume profile? Why aren't you using just today's session profile? Isn't that enough for the last few days? And the answer is no. I need to use all of the profile that's available to me. Market has memory. And I may have covered this before, but I'll talk about it in a little bit more detail. Volume profile is a super important part of our trading. It's an important part of it should be an important part of everyone's trading, because it's going to tell you objectively where support and resistance are, where liquidity zones are, and so forth. Also, where dealers are likely to be lining up, market makers, and so on, right? And the reason for that, the market or the volume profile, is a history of where they've been in the past. but where they've been in the past will affect directly what's going to happen in the here and now. Now, I don't want you to take my word for it. I can show you just by marking it up and then seeing for yourself that the older profiles that go back years still influence today's market. In fact, they have the most profound influence on today's market. But I'd rather you go and look at some of the works by people like Benoit Mandelbrot. If you've ever seen those Mandelbrot fractal images that are really cool, that have infinite depth. He brought us fractal geometry, but he was also a very big influencer in the markets and perhaps one of the world's greatest mathematicians. He's long since gone, but his work in fractal geometry has been unbelievable. He was also, in a way, a mentor, I believe, to Nassim Taleb. And we'll get into Nassim Taleb in future episodes, but he's the guy that came up with not the concept, but made the concept of black swans popular. And you'll find that everything that we do is based on that same philosophy that a black swan is, but at a different fractal. So if you put together black swans and Benoit Mandelbrot with fractals, you'll see that essentially what we're looking for are things that are like black swans that happen in the big stage, but in a much smaller fractal on a daily basis. That is essentially what we're doing. And things act that way consistently. So getting back to system or memory, market memory, Benoit Mandelbrot was doing a study on river basins and other type of geographical surveys and looking at them from a mathematical point of view and noticing that past floods and tide levels and things would repeat over time, regardless of how much rain had dropped, which was a rather interesting phenomenon. And it had a lot to do with how it influenced the coastal areas and erosion and all sorts of other things. But that's still what happened. And then he developed a whole mathematical formulation around this that he called system memory. He was definitely into finance and spent a lot of time on Wall Street influencing some of the biggest firms out there with his ideas. He also brought that same concept of system memory to markets and showed how markets also develop this same kind of system memory. And that's exactly what volume profile is. It is the embodiment of that system memory. Yeah, good morning to you guys that are on the chat. If there are more of you that have questions about volume profile or any of the things that we're going to talk about today, please put them out there. Be happy to comment on them and give this video a thumbs up. And if you haven't done so already, subscribe. System memory. Volume profile is an embodiment of that market memory that has happened over a long period of time. And it has influence, just as systems do, this market memory, on things that happen today. And so that's why we use it. That's why virtually every pro trader uses it. If you've ever hung around some pro currency traders, that's an interesting thing because everything for them is about levels. Where do you think these levels come from? They come from the influences of volume and where the market is traded and where it hasn't, and where are the inflection points between those. And that's what essentially you're seeing here on the screen is the places where the market has found value or where it hasn't. I guess that's another way to put it. Where they find value, where they don't find value, and where the edges are, where are the inflection points, the battle lines is another way to put it. But those battle lines, they persist. So you'll find that when you see a node, any of these nodes, and where we've retraced back, they really don't change. Once they're established, the market just goes with it. And so what we do is we look at where we're trading and make sure that we have all of the volume that we need in our area, and then we start marking up where are the boundaries of these features and the volume profile. And so and I'm not going to get too much into volume profile. Tomorrow's going to be the big day, but anyways, we're looking for the edges of nodes and the deep valleys and the crevices, any kind of place where there's been an abrupt change in volume, and we mark it up. We have to make sure we go way back. In our case, looks like we're looking anywhere from 6,200 up to maybe I don't know, 6,700. So we want this whole area in here marked up. And I want to go all the way back until there's no volume in the history. So really, all I really need to do is go back to about, I'd say about here or so, right? And that gives us everything that we need. So what I've done is I've marked this up and I've colorized the lines so I can tell where I am. Am I on the bottom of a node, the top of a node? Am I inside of a node, outside of a node? And so I have that all color-coded so that when I zoom in to a day trading level or a 5-minute chart, and once I zoom in, I don't really need the profile anymore because I've already marked it up, I can see where I'm at. And if you look closely here, you'll see these lines that I drew. And now, keep in mind, I'm now on a 5-minute chart. And how many lines, how many 5-minute bars are there in a day? You know, there's 6.5 hours to a session. There's 5 minutes into 60. So there's 12 times 6.5. So there's about 88, right? So there's 88 5-minute bars in a day. Now, when I was looking at that day chart, I can't see all 88 bars there. Obviously, I'm looking at that bigger picture. But when I zoom in, you can see it's a lot easier to see those 88 bars, but you'll find that within a day, there's a lot of movement, but that movement is almost perfectly aligned with those market structural levels. And they provide support and resistance. And they also give us an idea of liquidity, whether we're inside of a node or outside of a node. Inside of a node would be higher liquidity. Outside would be lower liquidity. And then the boundaries would also have their own kind of behavioral aspects to it that you'll learn over time, that you'll learn right here on this show. You'll learn a lot about it tomorrow. So we're here to identify where those levels are. And so the first thing that we want to do is mark up the sessions. Market is already opened. So I typically mark up the morning session and the afternoon session and the close. So I call the morning session from 9:30 to 12:30, and then from 12:30 to 2:30 is the afternoon, and then from 2:30 to 4 is the close. And all right, so now we have two things. We know how wide we're going. We're going to go 40 wide, and we know where the structural levels are. Now, why do we use the structural levels? Because we're looking to get into a trade. And the trade or the trading action is going to happen when there's an interaction with price with one of these structural levels. Now, there's a little bit more to it. We have to determine the trend. What is our trend? The way we typically do it is we'll look at a long-term, let's see, something like the Hull moving average or whatever. I'm going to look at a day chart here and put on the Hull moving average. There are a number of ways that you can do this. This is not the only way. This is just a way. What I can say is that when you've figured out what you prefer to determine which way the trend is, whether it's bullish or bearish, stick with it. Don't start jumping around looking at different things thinking that you're going to outguess the market, because our job is not to figure out where the market's going today. It simply isn't. We're simply looking for the trend to determine whether we're going to put on a put fly or a call fly above the market, below the market with a put, above the market with a call. You might think, if you aren't looking for which way we're going, why are you putting on a call or a put? The interesting thing is that it doesn't matter. It really doesn't. On any given day, it's going to be either up or down. Intraday, we're going to have moves up and down as well. So even if you're, say, bullish on that day and the day ends up being bearish, you can still make money on that bullish call because of those intraday swings. So that's a key point. But the reason why we go with the trend is so that we can capture those larger magnitudinal days that tend to be in the direction of the trend. That's the reason. Doesn't mean that we're trying to pick which way the market's going that day. As a matter of fact, we know that we can't. Let's just accept that. The market is too random. Things happen that the best laid plans, they go out the window. is that Mike Tyson says, everyone has a plan until you get punched in the face. And that's what happens. The market punches you in the face every time you try to outsmart it. And the market will beat you and punish you if you try to outthink it. So don't. Go with it. Understand that there's randomness in this. There are patterns in that randomness, and we can take advantage of those. So that's everything that we do. That's what it's about. Understanding the nature of the market and coming up with strategies that will be able to combat that reality, that it is a random market. It does have patterns within that randomness. We understand where volatility is. That gives us other patterns that we can go after. We know how that affects premium, etc. We also know that even though it's random, there are structure in the market that the market tends to respect. So all of those things are things that we can put in our favor and make money. Now, of course, it sounds like a wild thing that you go into, and it is. The market is tough, and the market can outlast your resolve, for sure, particularly if you're trading big. But if you trade small, the market can't hurt you. Definitely cannot hurt you. That's the key. So that brings us to our next thing. We're trying to put on, once we figured out what direction we're going. In this case, I know I'm jumping around a bit, so I'm going to recap. We've determined where the VIX is, so we know we're going with a 40 wide. Right? We've seen where the market structure is, and now we're going to determine which way the trend's going. Once we've determined which way the trend is going, that's going to tell us whether we're going to put a 40 wide call or a 40 wide put butterfly. In this case, I'm using the Hull moving average as one of the many ways that you can do this. I have it set to a 21-day period, and my reasoning behind that is most people would say that a market that is going in one direction for 21 days could reasonably be considered a trend. So that's what I do. And so when it's got a purple band, that means it's trending down. When it switches to the cyan band, that means it's trending up. So you can see that it's definitely trending up today. It's actually been that way for the past few days. So that's what I'm going to choose. I'm going to choose a call fly. All right. So now I know just about everything I need to know to get into this market. I am 40 wide. I'm going to do a call fly. And now I just have to figure out the when. So I have the why, the what. Now we need the when. And then the where, of course. The when and the where kind of come together. So let's go back to our structure. Now, you may think, hey, Ernie, aren't you trading the SPX? Why are you looking at the ES? That's pretty simple. The SPX doesn't have volume. It has no volume profile. So I must look. The SPX is a calculated index. So I must look at the ES. The ES has the volume. It's the same market. It's the E-mini S&P futures, the S&P 500. The index, the SPX, is also the index that calculates the S&P 500. So they're the same market. From a correlation point of view, they go tick for tick. Their correlation is in the high 90s, the correlation coefficient. So I'm using the ES as a proxy to the SPX. Now, that doesn't mean I can't trade the options on the ES. I certainly can. But what we're using the ES for is to understand where there's going to be a structural event. When that happens on the ES, I can guarantee it's also happening on the SPX because they're the same thing as I described. We don't really need to know the price level. We just need to know when there's a structural event. And what do I mean by structural event? That price is interacting with structure. And so on a move up, I'm looking for pullbacks into structure and then take a position at that time when there's a pullback to structure where I anticipate that it's going to then move up from that, in other words, bounce off of that structural level. Excuse me. Let's take a look at what we have then. Now remember I told you that I have color-coded everything. So the green lines I put at the bottom of nodes and the red lines I put at the top. So we can see very clearly then that there is a node here, right there. And there is another node down below here, right? So I know where the nodes are. And so I can see that we've been dancing around pre-market inside of this node here, and then as the market opened, it decides to move down. You can see also pre-market, it came down to the top of this node and recovered back right around 8 o'clock. And on market open, it's dropped down. So right now I have as I said, a bullish bias because I've determined we're starting an uptrend. So I want to put a butterfly on this. The question is where and when. The where is going to take care of itself. So all we really have to do is concentrate on the when, and I'll explain that in a bit. So we have a few questions. Rick says, excuse me, what charting visualization tool are you using? I already have the Observer membership, and I see the GEX, VP, 1 day, and risk buttons, but the visualization tool looks different. I'm not looking at the tool right now. I'm just explaining for everybody out there using TradingView. But you're absolutely right that in our tool, we have all of these features on it as well. And what I would recommend is that you go to the Discord and ask that question there, and I'll provide you with a detailed explanation. In next week, we're going to be looking at all of this stuff that we're looking at today, but within the context of our fly on the wall tool. But for those of you that don't have fly on the wall, I want to show you where it was all derived. All right? Thanks, Rick. And DBG, Ernie, wouldn't liquidity intent indicate more of a slippery slope downward versus up? That's not part of our strategy. It might, right? In other words, what you might be referring to is looking at the gamma exposure and seeing if we're in an expansion zone versus a compression zone, right? And are we in between nodes and it's a little lower liquidity? That's all very interesting, but that doesn't tell you direction. It doesn't tell you where price is going that day. And that's a mistake to think that you're going to tell where the price is going that day. It doesn't matter. I don't know how else to put it. It does not matter. Now, if you think you can, fine. If you think that you have, I don't know, the magic strategy that will tell you where the price is going, where it's going to end up that day, every day, good, use it. Keep it to yourself or share it. I would love to see it. It doesn't exist. Been doing this for a long time as a professional trader, institutional trader, hedge fund manager, been in the market for a long time, examining this. There is, and I think it's really a foregone conclusion. You're not going to be able to tell. So as I'm saying, we're picking a direction, we're putting it on, and I'm saying that even if we're wrong in direction, we can still make money. That's the key point here. Even if we're wrong, we can still make money. Are we expecting to make money every day? No. We make money about 50% of the time, and about 50% of the time we lose. You might think, that's crazy. Oh my God, 50% of the time, how will you ever make any money? The way we do is by keeping our risk super small and our potential profit very large. That skews it all in our favor. And we'll go over that a little bit more, a little bit later, and explain all that. But what we're looking for here, I'm going to continue on. We've already established we're in an uptrend. And I got to find my cursor. There it is. And so we're looking for, in an uptrend, any trend that it does stuff like this. It goes up, finds a level, and then moves on. We're looking for that pullback. So what I'm seeing here is there's a good potential that we're going to bounce off of this structural level here, the top of this node. Do I know that for a fact? No. There are things that I can do to give myself confidence that it is going to pull off there. The reason why it's here in the first place is because the market has done it many times before. There are other things that I can use to give myself confidence that's going to happen. You could use the GEX and kind of evaluate expansion and compression zones and see how the market makers and the dealers are lining up. And that might give you an idea of where dealer gravity is above or below the market. All of that is definitely in the wheelhouse for figuring out whether or not we're going to bounce off that level. You can look at divergences, you could look at price action, etc. However you choose to do it, I don't really care. I'd say whatever you do, make sure that you have a good routine around it and that you're consistent with the way you apply it. So let's say that I've chosen that, okay, that's a structural event that's happening right now. And I believe that we'll find support here and the market's going to move up. That's my hypothesis. So what I do next is take a position. So we already know, as I said, we're putting on a 40 wide fly, and it is going to be a call fly. So that means we have to put it above the market. If I know that we're potentially, or if I have a good idea that we're potentially going to bounce off of this level, then I want to put a call fly up here somewhere. How do I know where to put it? I already know how wide, and I also know what kind of risk to reward that I want to put it on with. So in our strategy, we have extreme risk to reward, and we have the 10% debit rule, which I talked about yesterday. The 10% debit rule says that we do not take a position that costs more than 10% of the width of our fly. So let's take a look at that. And now we're going to go to, let's see, what am I running here? I'm running Firefox. All right. This is the fly in the wall tool. By the way, this is the most cool tool you'll ever see ever for doing options trading and particularly for doing 0DTE work. And let me explain a little bit about what we have here. On the left-hand side, we have what we call a convexity heat map. All right. The convexity heat map is showing us the entire options chain in real time. We can look at different days, go out as many days as we want, or look at today. We can do various things by adjusting the gradient on it. But what it's showing us is across all the strikes that we're looking at, and you can see them over here on the left. Right here is right around where spot is, which is around 65.80 or so, right? And all of these tiles are individual option positions. So at different widths, they're actually representing butterflies. And so you can see up here are all the widths of the butterflies up top, right? And you can see things are changing rapidly as we're talking. But the debit price is in the middle of the tile. And so I'm looking for a call fly that is 40 wide, right? So I want to find a tile or a price that's going to be in my wheelhouse. Now, you'll start to notice as the day moves on, the pricing structure starts becoming more and more realized. So right now you're seeing a pricing structure. Yeah, I'm going to get my little annotation tool. You'll start seeing these sort of bands going like this way and this way. And that'll start becoming more and more defined as time moves on and the market settles out and so forth. And pricing starts becoming a little bit more realized. But we have this convexity heat map is showing us where pricing is falling off very quickly. And as we get further and further away from spot up here, you'll start seeing them getting darker and darker. And then eventually they'll start turning red. And let's see if I can demonstrate that. I can bring red in a little bit. I can show where that's happening more quickly here. There we go. All right. So what that's showing is the rate of change of the price of our flies. As we get further and further out, I'll see all of a sudden it just went nuts, but it'll settle out. As we go further and further out, that change starts happening more quickly. So what we're looking for is a fly to put on, and we're looking at 40 wide. We don't want to pay more than $4. Here's where $4 is. And you can see that just 2 strikes further out, there's one for $2.72. So I think I'm going to choose that fly right there. Bam. On. It's that fast, really. So I can find a fly that meets my pricing requirements, click on it, and bring it right into my risk graph. And then from here, I can do all kinds of analysis. Of course, this risk graph is very similar to what you might see on Thinkorswim, but it's way more powerful. I can do all kinds of things. Let's say that this isn't really the fly that I want. What I could do is I'd say, I want it to be a little closer to the market. So I could grab it and then just move it a little closer, and it will reprice itself. Or I can move it a little further apart, a little away. Or maybe I want a broken wing fly. I can take one of the legs and grab it and like that, and I can put myself into a broken wing fly. So these are things that you cannot do on Thinkorswim or any platform. I can move that around. I can also look at various things that are going to help me visualize that butterfly with respect to gamma walls and the GEX, simply by bringing up the GEX in the background. I can also bring volume profile into the picture and see where the nodes are relative to my fly. Right? So incredibly powerful tool. And our GEX tool has all the same tools that you would see on any sophisticated gamma exposure chart. I can look at calls and puts at the same time. I can even look at the absolute value of gamma or the net value. Right? I can also view my fly in an orthogonal direction. What do I mean by that? This is your standard risk graph. But here I can look at it from a top view, right? And so what I'm looking at really is the market from above. And so there's my call fly above. Here's the market below it. So if I go back to this view, I'll get my highlighter. So what I'm doing is I'm looking at the market from up top here, down at it. So each strike I see as a line here and here, right? And then this area, which is the profitable area, right, all the way through, that's what I'm seeing here. I have to switch annotation tool when I go back. When I look at the time view, that's what I'm seeing. I'm seeing a slice of this profitable area. What you're seeing here is what the decay is going to look like at the end of the day. Until you get to the end of the day, it just decays away. And right here is the time that we got in. That's why I call it the time view. So we're looking at our butterfly from a bird's eye view and seeing what it's going to look like, and we can then see price and how it interacts with our position. So it's just another view. Again, this is a view that nobody else has. Of course, we can go back to our risk view. I wasn't planning on showing the tool, but it's so hard not to show it. Yeah, so we're all set up here. We can get into this. Look, it's $2.68 here. We can lock it in right there, and if we want to, we can send that to our simulated broker, or later on, I'm going to have adapters so that you can hook it up to Thinkorswim or Tradier or any other broker that has an API. And so you can then use Fly on the Wall as your sidecar to your brokerage with these advanced options tools. If you want to find out more about it, go down below, take the trial. It's $17 a week. You can try it for up to 4 weeks, cancel anytime. So very low risk to come in and find just how great this tool is. Plus, you'll be able to join our Discord with a bunch of like-minded traders that are all trading 0DTE. It's the place to be for 0DTE. I'm the original 0DTE business on the net. Been doing this for a long time. It's going to be a fantastic experience for you. You're going to learn how to trade asymmetrically and convex setups. So give it a shot. If you like this content so far, give me a thumbs up, subscribe, and check out the Observer tier and join Fly on the Wall. Hundreds of others have, so you might as well too. So we've got our analysis platform in here. We can see where our profit is, where our risk is, so forth. We can also do a what-if analysis. We can see what this is going to look like a little later in the day simply by advancing time. And so we can see how it's going to manifest itself. Oh, look, at 2:40 in the afternoon, the break-even is going to be way out here, not here, where we were. Or what happens if volatility or price starts going up? How will volatility react? If it comes down, it will look like this. If it goes up, it'll look like this. Right? So this what-if analysis is super cool. All right. Other tools that we have dealing with dealer gravity and so forth. Dealer gravity we have right here. And this tool will tell us, relative to spot, how strong dealers are trying to push markets up or down. Right now, it's almost a dead even. They're right near spot, only within half a point or so. We can also look at whether or not we're in a compression or expansion zone. Right now, we're more into expansion. And we can also look at other tools like the liquidity intent map. This will tell us whether or not we have this crossed with directional bias of the dealers with the liquidity friction index. So when we're in the lower left, that means that we're much more apt to have downside acceleration. You might say, damn, we put on a call fly and this tool is saying downside acceleration. It doesn't mean it's going to go to the downside. What it means is that the downside is more receptive to moves going down. Now, it could find support there and then turn it around. We don't know. But these tools will allow you to visualize that at any point. And then this tool here is actually the same tool that we used in the VIX, showing us, I need to make this bigger so you can see it, but this is our VIX playbook, showing us how wide that we should be choosing. Right now it's indicating 40 to 50 wide, and also the strategy that it recommends. So you have all these tools available to you, specifically designed around 0DTE trading. We will do the simulated trades later, Gary. I don't have it quite ready, but don't worry, there's going to be a full, at least dozens of shows on simulated trading once we get that all set up. So you can put multiple strategies on here at one time and analyze them all at the same time. Let's see. I keep on losing my mouse. There it is. So for example, if I wanted to also see a put fly on here, let's take a 40 wide put fly. Let's see, pay about the same price, about 270. Let's put that on there. Okay, so there's our put fly. All right. So we can analyze two things at once. All right, let me go back to the big head, and we're going to talk about what we wanted to talk about, and that's position sizing. So yeah, you know how wide you're going to make it and approximately what you're going to pay for it. Both of these flies are in the $2.50 range, $2.50. So on the SPX, that would be about $250 for that fly. For a potential, because they're 40 wide, that's about a $3,750 potential if you pinned it. So we're putting up $250 to make about $3,800. Now, is that what we're going after? No. What we're really interested in is the optionality between where we are and towards the fly. Because even if you move towards it, you can still make up to 250, 300% without ever getting into the fly profit tent. And so that's what we're really after. Those kind of returns, 100, 200, 300%. Now, if we get in the profit tent, which is a lower probability event, but if we do, you can make up to 1,000 or 1,500%, which does happen. And that's what I'm going to show you in my own personal trade log that I've used on this service, what that looks like. So most of the time, we're making these small wins, medium wins, and small losses. Small, medium wins, small losses. And again, losing about 50% of the time, winning about 50% of the time. But our 50%, those small and medium wins, they essentially offset the losses. And then when we get to the big, medium to big wins, those are the things that move our account. What we're not doing is we're not drawing down, right? We don't have big, huge swings in our market. We're essentially playing for a tie most of the time, staying in the market, waiting for the opportunity, and then being prepared for that opportunity with a convex trade like the butterfly. And when it comes, that's when we elevate our account. And so I want to show you what that actually looks like by examining an actual account that was working that way. Okay. So I have a couple of accounts here. I have several accounts that I've been using over time, but Let's see if I can get to that right now. It's in Excel, Microsoft Excel. Which one is this? This one right here. All right. So this is an actual account that I took on my Zero DTE service over a period of about 18 months. I started with a relatively small account, about $23,000, to show that how I could trade even in with the pattern day trader rule using this strategy, trading 5 days a week. And you'll see, hey, it's a pretty performant account, right? There's about 460, a little over 460 trades here. This is showing pretty good consistency. The things that I want you to note is the low drawdown. Never got below 6%. In fact, most of the time it was around 2 to 2.5%. All right. Nice tight equity curve. But if you look very closely, it does what we call a stair-step. And this is the point of this show. Remember I said you're playing for a tie most of the time. That's the runner on a stair. And then occasionally, not occasionally, about 15, 20% of the time, you're going to make inordinate profits that go way above those things, and you're going to rise. So stairs have this thing called runners and risers. You run, that's the step, and then the rise, that's where you step up. And that's exactly how your account will behave when you practice this strategy. And you can see it manifest itself right here. Let's bring on the annotation so I can show you that. I started off nice and clean on here and rose. I got lucky, but then went across and then up, across. So that's the pattern, stair step. Okay. Now, we'll go into more detail at some point exactly what this period looks like, because in this particular case, this is over 50 trades. You might think, man, how can I do 50 trades and just go sideways? If you want to achieve this kind of performance, then that's what you have to do. If you think that you can just win every day, that's not going to happen. These high win rate strategies will, sure, they'll give you this like nice little grinding up, but then you get those big losses that do this. And then you grind up, and then you have another big loss. And then you grind up, another big loss. And maybe you'll get up to there again, but what you won't do is you won't have consistency all the way up. And you need that in order to compound. Right? This situation here with nice incremental wins and then big losses will never allow you to compound. We talked about this in past episodes, so take a look at it. Let's see, there's another question. Coach, in that account, did you use the 21-day hull to pick direction for each trade? Actually, no, I used a rather novel approach. I used my fuzzy eye method. I looked at the market and I said, okay, the market's going up or down by just squinting my eyes and seeing which way it told me it was going. That's how, but I got a fairly, you could say that I got a kind of stochastic resonant view of the market. And that's essentially what I'm doing. I'm diffusing my eyes so I only see the essential outline of which way the market's going, and that's the way I went. And with that kind of market direction picking, that's the kind of performance that I got. All right. Now, how good is that performance? First of all, you can see that the win rate under 50%. All right. But my average risk per trade, or my return per trade, is for every, okay, that's the average risk. Let's see, let's take a look at another number right here. This is the important number. The average winner versus average loser is almost 2 to 1. All right. And my risk to reward that I was taking was averaging a little over 10. But here's the important part, Sharpe ratio over 5. That is high frequency trader, institutional Sharpe ratio action. You don't see that in a retail account. You do in mine, but you don't see it in your average retail account. So this is spectacular performance with a very low win rate, right? And low drawdown. I am never sweating a trade, ever. But I am doing this riser and playing for a tie most of the time. Most of the time, I'm playing for a tie. Yet when you step back, you start realizing that, man, it looks like he's making money all the time. About 50% of the time, and 50% of the time I'm losing, but my winners are outpacing my losers by a lot. Now, I have other accounts where these things, they were using a slightly different variant of our 0DTE strategy. And I have those out here as well. This is a composite of all the accounts, but let's see if I can find some others. All right, so this account here is using super out of the money, way far out of the money, and multi-day accounts, typically anywhere from 0 to 5 DTE. But again, using very wide flies, 50 wide, out of the money, and then being opportunistic on the returns. But you can see here, slightly different win rate, about 61%. But most of the time, during the execution of this account, say from here to here, I was actually closer to about 42% win rate. But this stretch right here changed everything and brought me up to 61%. That happens. Sometimes you just have a streak of good luck. But you can see here, again, almost a 2-to-1 average win to average loss. Drawdown here never got beyond 2%. Sharpe ratio around 4. Average risk to reward almost 34. Right? Huge difference. Am I showing? Oh, I'm not showing the same account. I just realized that. Let's see. That account is called the Fat Tail account. That's this account. Sorry. Yeah, again, 61% win rate, all really due to this area right here. For this area over here, I was like around 40, 42%. And then that changed. Is my pointer working? I think it is. Then I have a composite account I can show you that takes all of the accounts that I traded in the service. Let's see if I can show you that. So this is a composite account showing almost 700 trades trading this methodology. You can see the first account is actually right here in the beginning, and then I added in the other accounts that I traded. But you'll also see that how it's starting to compound. What I mean by that, it's starting to curve up. And I'll talk about that tomorrow too. There's not enough time to talk about it today. It's starting to curve up because I changed my position size. And so now I'm working with a larger overall position size with the same strategy, so now it's got a different trajectory. Over time, that will change, and I'll add even more to my position size when I can justify it by going to the next level, and then it will start curving up. But that is the result of trading this strategy. All right, let's go back to the big head. All right. So what I wanted to show today, what trading is with this strategy. Highly asymmetric, very small risk, large potential reward. That is what will give us that mantra. Consistently profitable, as you can see, obviously consistently profitable with very little drawdown. You'll be independent because when you join our service, you're going to know why you're making that kind of money and why you're sizing the trades the way you're doing it, and how the market and the influencers, the dealers, where they're positioning themselves, how to read GEX, how to read volume profile, how to understand market structure, place your trades appropriately to give yourself the proper risk-adjusted returns. You'll know all that, and so that will make you independent. And knowing that, and then trading it in a consistent manner, going back to last week when I talked about routine, that's going to teach you how to trade at a pro level. So there you go. There's the three. Consistently profitable, independent, trade at a pro level. All three of those things you'll find right here down below. Check it out. All right. I don't have any more time. Got to get going. I want to thank you all very much. Thank you for the questions. Please give this video a thumbs up. I really appreciate it. And let's see, there are a couple of others. What is the story on the largest loser, $900? Oh, I don't know. There's the story. It's another day. A $900 loser at that time I was dealing with about $100,000 account isn't particularly life-shattering. It's less than 1%. So those things happen. Big losses happen. Position size, we'll go over position size tomorrow. I was hoping to get to it today, but tomorrow I'm going to go over a very specific, and I'll give you handouts too. I've got a document that I wrote up. Let's see if I can get it up here. Preview. So I've got this position sizing document that I'll share with you tomorrow, and I'll talk to you in great depth how we actually calculate our position size. And this is going to give you some incredible insight on how to appropriately size your positions based on your account size and your strategy. So we'll look at that tomorrow. And any more questions? No, that looks like about it. Rick's saying that Sharpe ratio is huge. Yeah. I don't think people will have an appreciation for when I say that my accounts have Sharpe ratios of 4 or above. Most other pros say they don't believe it until they see it. And, all right, Rick's asking, I might have missed it. What time period is that chart? All of those trades represent between 2022 and 2025. So over that 3-year period. And, yep, that looks about it. Thank you very much for the questions. Again, give this video a thumbs up, please, and I'd really appreciate it. We'll see you tomorrow. We'll talk about volume profile in depth, and we'll talk about position sizing. Let's see. Let's go back to the big head. There we go. All right. I hope you all have a great trading day. If you want to learn how to trade this way, go down below, sign up for the Observer. It's a paid trial, 1 week at a time, virtually no risk. The risk is like the cost of a sandwich, and you're going to learn how to trade this way. Get an equity curve like I have. All right. All right, everybody. Thank you very much. Take care. Ernie out.